Hey guys, it's me Crypto Phantom, and today is day 6, 365 days bootcamp challenge of becoming a profitable trader. Today lesson: fair value gap objective. Understand how to use fair value gap within liquidity plus structure for better trade execution. We're gonna read Trading in the Zone by Mark Douglas, whole chapter 4, and we're gonna focus on thinking in probabilities, accepting uncertainty, detaching from outcomes, and always write 3 to 5 key takeaways from the book. And if you guys want to read this book, you got bunch of PDF for audio in YouTube. And we're gonna today and later we're gonna watch SMC for 30 minutes something. Fair value gap basically focus. FPG imbalance in price forms after strong move. Displacement works best after liquidity is taken. Understand where FPG fits in the market story. Later we're gonna do chart practice for 5 minutes probably, and we're gonna do mindset session throughout the video. So this is for today, and let's go. So chapter 4, consistency, a state of mind. Let's read it. Sorry that I had some glitches problem with my camera and it would stop the midway. So I just fixed it. Hope that during the recording it doesn't affect. If it affect, guys, don't worry, okay? Like some normal problem. Let's start. Really understanding risk. aligning your mental environment. Guys, I am having the camera glitch. For example, let me explain. Like throughout all this chapter that we read right now, most of there it was nothing really to explain because it was basically like saying like mental conscious level mindset. It basically talking about these which we already learned in chapter 2 and chapter 3. It was reminding us that what we were taught in chapter 3, and it's good, like Trading in the Zone is such an interesting book. And if you really want to read it yourself, you can find the file anywhere in the Chrome or Google Chrome. You can just search Trading in the Zone by Mark Douglas, free PDF, whatever, you can find anything. Let's start. Guys, for example, like throughout this chapter, throughout these pages, we were learning like the friend who was afraid of snake. So basically, right now, I found a gem. What he's saying basically right now, that we can distinguish distinct distinction, like we can distinction ourselves, like which one of this snake is dangerous for us, and it's not dangerous for us. So we ourselves, we can distinguish that. I mean, we know that which trade we gonna take is can be dangerous and cannot be dangerous. Okay, that's good lesson. So guys, I was just researching, like Cold Hand Luke movie, and yeah, that was, let's read. Just look at this, bro. Like, the guards were determined to not let Luke make fools of them a third time, so while forcing them to an inordinate amount of work with no rest, and giving him intermittent beatings, they kept asking, "Have you got your mind right yet, Luke?" Eventually, after considerable suffering, Luke finally told the prison bosses that he had his mind right? They said that if he didn't and tried to escape again, they kill him for sure. Of course, Luke attempted another escape there, and true to their word, the guard killed him. Like Luke, many traders, whether they realize it or not, are trying to have it their way by beating the market. As a result, they get financially and emotionally killed. There are easier, infinitely more satisfying ways getting what you want from the market. But first, you have to be willing to get your mind right. That's some good message. So guys, we just finished Trading in the Zone chapter 4. Tomorrow we will day 7, we will do chapter 7. Hope you like the content in chapter 4. Even if I didn't explain much, like I'm just like this is my bootcamp of learning, not explaining. So if you want to read it yourself, you got bunch of things like audio or PDF, so let's go. Now we will watch the YouTube video. Guys, as you've seen, this is the video. We're gonna learn how to trade fair value gaps, advanced FVG concept we're gonna learn today. And let's start.
So, today our topic is about FPG. What does FUG mean? Fair value gap, which is referred to as SMC or SMC and ICT. This is a terminology from ICMC and ICT, which we also call imbalance. Okay, so, what is FUG? Okay, so, today we'll cover a lot of topics. Like, what is FUG? And why does FUG attract the market like a magnet? Okay? Like, why does the market reverse after hitting FUG? And if you have a FUG created on a higher time frame, how do you enter it? And after that, if multiple FUGs are created in one leg, which FUG is actually going to work? We'll learn all those things, but before we can understand it in depth,
understand the psychology
Basically,
of
he's
FUG.
saying,
What is FUG?
what is
How does it work?
FPG, okay?
Its basic components.
we'll learn about them, and I'll write them down. No one on YouTube knows these basic components, because they themselves, and that's all they teach. You're only taught about order blocks and FUG, but they don't know the deeper psychology and some of its components. So, what will they teach you? Okay, then, along with that, what is FUG start momentum? What is FUG pill? What is inversion? What is CB? What is BC? What is a volume gap? What is a normal gap? We'll understand all these basic psychological components of FUG. And then we'll move on to how FUG is created on the chart and how to trade it.
Guys, by the way, prepare your notebook, okay, because we have to write it down. For example, I got everything, I have everything right, and you should also write yourself.
Your stop loss. We'll discuss all these things one by one. So stay tuned, there's going to be a lot of innovative content. You won't get it on the entire YouTube channel, that's guaranteed after the video. And here, in the middle of the video, I'll give you all the information. So keep watching. Okay? So, now let's understand what FVG is and how it's formed on the chart. Okay? So, the full form of FVG is fair value gap, or what we also call imbalance. Why does it form? Look, whenever there's a big momentum in the market, whether it's due to news, big players entering the market, or any other reason, if there's momentum, it leaves footprints behind. Correct? Whenever these FVGs form on the chart, correct? They always tell you that a movement has passed from here. Correct? So, what does that tell us? Okay, a big movement has come from here, so there must be something that's caused the big movement. Okay? Whether it's due to news, price action, the entry of major players, or anything else. But what happens is, when the market dramatically shoots up from point A to point B, there's no price behind it, and that's why a gap is created. Okay, so what does a gap mean? Volume imbalance, what we call a gap over a gap, is how it happens. For example, a candle forms. Let's say these aren't two candles, but a candle forms, a second candle forms, and a third candle forms. Okay, so what happens is that each candle closes above the previous candle. So, what's the psychology here? The bias is in control, okay? And if we look at the candles from the bear side, what's happening here? The first candle opens and closes. After the second candle opened, it closed below the first candle's low. After the third candle opened, it closed below the second candle's low. So, what's the sense here? Sellers are in control, and the price action here shows that there's been a dramatic movement. Why? Because if you look at it, a gap has formed between the first candle's high and the third candle's low. A second candle formed in between, let's ignore that, okay? But there hasn't been any trading between this third candle and the first candle's high and the third candle's low. Right? There hasn't been any trading here. So, what happened is that the price started from here. It closed from here. The second candle also closed above that. The third candle also closed above that. So, a gap has formed in between, correct? So this is called the FVG, fair value gap, or imbalance. So, that's your buy side fair value gap, correct? Now, how do you calculate the sell side fair value? The low of the first candle and the high of the third candle. Okay? This is what we call your FVG. Okay, so, we've understood what a fair value gap is. Now, understand which fair value gaps are not valid. Look, what we've learned is that there should be a gap between the high of the first candle and the low of the third candle. What's happened now? Look, the weak of this third candle is already within the weak of the first candle. So, would this be a valid fair value gap for us? No, this fair value gap won't be valid for us. What does it mean for us? There should be a gap between the first and third candles. Okay? Whether it's a weak or a completely similar body, it's fine. If the third candle overlaps the first candle, then there's no fair value gap for us. Okay? Similarly, on the sell side, the low of the first candle and the high of the third candle should not overlap. If they overlap even slightly, then there's no fair value gap for us. Okay, that's it. We've defined which is a fair value gap and which is not. So, this is how a fair value gap is created in the market. How does it happen? If the first candle is a fair value gap on the bullish side, then you have to leave out the high of the first candle and the second candle. Whether the third candle is weak or not, the low of the third candle, whether that low is its weak or the body itself, is fine. Simply the low of the third candle and the high of the first candle on the bullish side is the fair value gap. If a gap is created between these three candles, then we call it a fair value gap. How is it on the sell side? The low of the first candle, the second candle, and the high of the third candle. This tells us that if there's a gap between these two, it's a fair value gap. Now, you'll say, we'll take this week only? No, if it weren't for the week, okay? Let's say it wasn't for the week and only this remained. What do you say? What if the body remained? So, we'd take the body, okay? We simply mean that there should be a gap between the low of the first candle and the high of the third candle for the sell side. Okay, now that's understood. This is FVG, or a fair value gap. Okay, so how is it formed? Because the price has moved dramatically from here, it leaves a gap in the middle. Why? Because there hasn't been any trading there. The large orders placed here push the market, and the price moves dramatically higher. So, there hasn't been any trading in the middle portion here. So, that's why a gap is created here, which we call the fair value gap or imbalance. Right? Sir Michael J. Edelston invented this. He has 30 years of experience. If you want to gain inspiration or mentor someone in trading, then choose people who have achieved something. They're showing off their RXs on their Instagram, showing off their cars, showing off their home tours, and showing off their lavish lifestyles, just selling you dreams. Don't follow them. Don't do this. If you want inspiration, seek it from people who have truly achieved something, right? I've personally been inspired by watching all of Sir Michael J. Edelston's videos, and because of him, I've been able to learn SMC very well. Yes, you have to put in a lot of time. You have to put in experience for that. You have to do back testing, right? So, let's get back to the topic. The FG has been created. Now that we understand what FG is, let's analyze it on the chart to see what it looks like. Okay, so, look, this is a 1-hour chart of USD JPY, and what's happened here? Look, what did I explain? If you want to find a fair value gap on the bullish side, what do you need to do? Mark the high of the first candle and the low of the third candle. There's a gap in between. Forget about the next one for now, okay? Forget about the next one, which is visible here right now. But let's assume that only 3 candles have formed, the first and third candles. So, what is it? You've marked the low of the first candle, the high of the third candle, and the low of the third candle. Okay, you found the fair value gap, okay? On the bullish side. How to trade this? We'll understand all this later, but for now, I'm just teaching you how to mark a FG. This is your fair value gap on the bullish side. And where is the fair value gap forming? Look, one is forming here. It's forming very small. It doesn't matter if it's forming small or big. You should just keep marking it. And where is it forming? It's forming here. Again, I'll ask you why you didn't do this. Why did you do it? We'll discuss all this later. Right now, we're understanding how to mark a FG. Okay? We've put in the marking. That's it for the bullish side. Now, let's understand a fair value gap on the bearish side. Okay? So, I'm seeing a little bit of a downtrend structure here. So, how do you mark a fair value gap within a downtrend structure? The low of the first candle and the high of the third candle. That's what you have to mark. Right? This is your fair value gap on the bearish side. And where is it once? And one is just below it, right here. The low of the first candle and the high of the third candle. You have to mark these. And where is one? And look, your one is right here. It's right here, okay? This is again. So now you know how to mark a fair value gap. Okay? Now let's understand why a fair value gap acts like a magnet in the market. Okay? Now you all know that the market runs on only 2 things, liquidity and the fair value gap. The market runs on only these 2 things. I'm not saying this, brother. Sir Michael J. Huddleston, the creator of SMC and ICT, says this himself. The market runs on only 2 things, liquidity and fair value gap. Okay, why? Because a fair value gap is itself a liquidity. And because there's no trading there. When the price shoots up from here, the market is attracted to the fair value gap. Why? Because there are pending orders there. So, the market definitely comes to fulfill them. So, the fair value gap itself is a liquidity factor. Right? So, that's why the market is mostly attracted to the fair value gap, right? You've seen that a fair value gap has formed, right? Let's assume that there's a fair value gap here. The market had run up from here. Why does the market come back here after reaching here? Why doesn't it return from here? No, because the fair value gap itself is a liquidity factor in the market, and the market comes to take that liquidity, and then the market reverses from here, right? After taking the fair value gap, right? So, the market is attracted to the fair value gap like a magnet. And after hitting that zone, it reverses from there. Okay? Now let's understand why the market reverses after hitting the fair value gap or after it reaches the fair value gap. Okay, so let's understand this a little. For this, I'll explain the psychology. 1 second, look at this. Let's say this is point A. The price has moved dramatically from here to here. Okay, so someone has placed a buy here. Okay, some large orders are placed here. Let's say their order quantity is 100,000 here. 100,000 orders are placed here. What happens here? What happens when a large quantity suddenly arrives here? Let's say they bought at this price. Suppose a big player decided to buy 100,000 quantity at 10 rupees. What happens? For 100,000 orders to suddenly be punched in at 10 rupees, you need to have the same psychology I told you. If there's a seller, there needs to be a buyer as well. So, if there's a buyer, there needs to be a seller, right? If I want to buy 100,000 quantities here at 10 rupees, then I need an order from that person. Correct? I need 100,000 orders for selling. I can only buy if someone is willing to sell for 10 rupees. If no one sells, how can I buy at 10 rupees? So, what happens when a large quantity suddenly arrives in the market? The price shoots up, right? All the other orders go unfulfilled. Let's say there are 100,000 orders, and 400 to 500 of them are fulfilled here. Orders go into pending, right? So, because of this price shoot up, no one will buy at that high level right now because the larger orders are placed below, and there are also pending orders from big players. Correct? So what happens here is that the price comes back to pick them up. It comes back to fulfill the pending orders. And when these pending orders are fulfilled, the price again gains sharp momentum. Why? Because after suddenly reaching that zone, the pending orders, let's say there are 100,000 orders. Out of 100,000 orders, 500 orders have already been fulfilled, and 50 orders have just arrived and been fulfilled. So the price will get a boost from here again. And secondly, the psychology here is that everyone knows the supply and demand zone, support, and resistance. So, this momentum has developed here. So everyone knows that if it comes back here, then momentum will be gained here. Retail traders also enter here, and because of them, the price gets a significant push, and the market even rises above its previous high. Or, let's say, after the fair value gap is tapped, or after orders are fulfilled in that zone, the market reverses. Okay, so, this is market psychology. After the fair value gap is tapped, or after reaching the fair value gap zone, the market reverses. Okay, let's consider this example on a chart. This is a 1-hour chart of USD JPY. What did I do here? I saw an order block here. Sorry, the fair value gap was visible here. I marked it. What happened now is that the price created a fair value gap here, okay? And the price moved up, okay? When the market price came back here, it reacted once again. And when it came a second time, it reacted a second time, okay? And are you seeing the price momentum? There was a fair value gap here. What did the market do here? It tapped the fair value gap. And you can look at the momentum in the market, okay? There was such a huge momentum, okay? So which fair value gap to take? Which one to take? I'll explain it to you in detail. There was a fair value gap here. The market tapped above the fair value gap. And look at the momentum, okay? So this is the market momentum after tapping the fair value gap. Okay, now that's the buy side. Now let me explain a little bit about the sell side. Let me explain to you the fair value gap, how it works, and how you see a significant reaction when tapped. Okay, for example, this is a 1-hour chart of the USD JPY. What happened here? This is the first candle, the second candle, and the third candle. The low of the third candle, the low of the first candle, and the high of the third candle. What happened on the selling side? First, we did a breakdown, tapped the fair value gap, and then went down again. Okay, with a good amount of momentum, we got a pay down here, and then a sharp fall. Okay, so, this is how the market reverses after tapping its fair value gap or reaching that zone. Now, where should we enter? We'll also understand its basic components. But before that, let's understand a little about what consequential increment is. What is the psychology of a fair value gap? We've understood that. What is FG start momentum? What is field momentum? What is BC? What is CB? What is inversion? What is an inverse fair value gap? What is a volume gap? We've understood all of this. Look, there are 3 basic components of a fair value gap. Let's say this is your fair value gap, okay? So, the upper part is what we'll call the FG start on the bullish side. Okay, on the bullish side, it's the FG start. Okay? This middle line is what we call CE. Okay? Let me put its full form in, consequent encroachment. Okay? And the bottom line is what we call the FG field. Okay? I'm talking about this bullish side. That is, when the market is in a bullish trend. Okay? And what will it be like here in a bearish trend? Its opposite will be, FPG fill will rise and FPG start will fall. Okay? Now, if I explain to you how this works on a chart of USD JPY, here. There was a chart of USD JPY in the bullish trend. What happened here? A fair value gap was created in a market. Okay, we marked this fair value gap. Now you might say that we understood the FG in this. What are the components of a fair value gap? CE means across consequent encroachment. Now, what is that? This middle line is what we call consequential encroachment. And how is it calculated? It's simply 50% of the fair value gap. Okay, let's say the FUG is this big, then whatever is 50% of it will be the CE. And whatever is the CE, that's why I've drawn that middle line. Now, how to do this? You need to go to a box. Sorry, where did this box go? Yes, go to the box on TradingView. Create any box that matches the start and end of your fair value gap. Then go to its settings and enable the middle line option. Choose any color you want. If you want a dash, use a dash. If you want a line, use a line. It's up to you. You just need to know that this is the middle line. Okay, so you've understood. What's the scene here now? This upper part, you'll ask where it starts. You'll say it starts here. No, it starts here. Why? Because the market has already crossed and tapped it, right? When it returns, where will the first tap happen? It will be on the upper side, correct? So this is the starting point, this is the CE, and this is the FG field. Let's say this is the start, this is the middle, this is the end. Let me explain it in simple terms, okay? That's your bullish side. Now, how can we do a little bearish side? Let's look here. If a bearish FG has formed, yes, look, I'm just explaining this to you. We'll explain the rest of how to trade it and how not to trade it later. This FG here is the bearish FG. This is a 1-hour chart of USD JPY. This FG has just been created here, correct? So, what will be the starting point here? Will it remain? No, the starting point will be here, the one below. Why? Because once the FUG is already below the FUG, and when it reverses, where will the first tap be? It will be here, on the lower side. So, the lower side will start on the bearish side. The CE will remain in the middle, and the one above will be the fill, okay? So, brother, this is the basic component of the FPG. And what do we have to do with this? Right now, we need to understand what a higher BC is. And what is a CB, okay? So, let's understand a little about BC and CB. What is it? What is it called? And what does it mean? How do we identify it? Okay, BC means buy-side imbalance, sell-side inefficiency. Okay, that means this bullish fair value gap in these shorts. Okay, so the full form of BC here is buy-side imbalance, sell-side inefficiency. Okay, now, if we try to understand it word for word, what does it mean? Buy-side imbalance means that at the time of buying, there was unhealthy price action. Okay, an imbalance has been created here. Okay, so, what do we call it? Buy-side imbalance. Now, what does sell-side inefficiency mean? The market moved to the sell side here, so it was for a retracement, or whatever. A sell-side move came, right, but that sell-side move wasn't fully fulfilled. It made a U-turn from there. That's inefficiency, right? So, this is what it means. Buy-side imbalance, sell-side inefficiency. That's your understanding of the buying side. Now, let's understand the selling side. What does CB mean on the selling side, and how? Now, for example, we have created a fair value gap on the sell side. So what do we call this fair value gap on the sell side? CB. What does CB stand for? Sell side imbalance, buy side inefficiency. Okay? If I get the spelling of inefficiency wrong, understand it, because I don't even have a spell checker on here right now, and I'm a 5th grade failure. Okay? So, look here, understand the deeper meaning of sell side imbalance and buy side inefficiency. Let's understand it word for word. Sell side imbalance, you already know from the name. Unhealthy price action on the selling side has created an imbalance. Imbalance balances the imbalance, okay? I'm not saying this, it's also used by Sir Michael J. Heddleston. He keeps saying in his ACM to ICT that the market always tends to balance its imbalance. Okay, so, a sell-side imbalance has been created here. Correct. That means a sell-side FUG has been created. So, this created situation is what we'll call a sell-side imbalance. What happens next? What needs to happen to create a sell-side imbalance? Buying occurs. That is, a pullback occurs. But does that buying completely cover it? No. So, what happens is that this buying remains incomplete and takes a U-turn. So, what happens? There's an inefficiency on the buy side. That means the buying side wasn't fully fulfilled. The end return veered towards the halfway point, towards IFG, right? So, this is what happens, brother. Buy-side imbalance, sell-side inefficiency, and sell-side imbalance, and buy-side inefficiency. The full form is BC and CB. Okay, so, did you understand that much? Now we'll understand what an inversion is. It's the inverse of the fair value gap, okay? After that, I'll explain where to enter, how to trade on higher time frames, and how to trade the FG. But first, understand the basics because they're important. Until you understand them, nothing will be of any use, okay? So, let's understand what an inversion is. Look, inversion means that whenever the market creates bullish candle forms here. Okay? A bullish candle forms here, and what happens is that the market again forms a selling candle. So, what's our point about the FG at S? The market should tap the FG and reverse the FG, correct? But what did the market do? The market filled the FG. What should the rule be for the S at S? When the market creates an FG here, what should the market do? It should tap the FG, and from there, you should see momentum in the market, correct? But let's say it doesn't happen that way. What does the market do? It closes below the FG, so what happens? This is called inversion. Right? What does that mean? The market has failed this FG. Right? This FG has failed this FG. So what is it called? Inversion. And what does it become? After inversion, it becomes an inverse fair value gap. What does that mean? Until now, it was a fair value gap on the buying side and the bullish side, as long as it was closing above it, correct? But when it closed below the FVG, it was no longer a fair value gap on the bullish side. We consider it a fair value gap on the selling side and trade it as an inverse fair value gap. So, what? That is, it closed below it. Whenever the selling side taps above this again, we'll sell from here again. Okay? So that's the concept, nothing more. Let's understand this on the chart. Okay? How this inverse fair value gap and inversion happens. Okay? Look, we've got a great example of an inverse fair value gap here. What have we got? Look, an inverse fair value gap has formed on the selling side. Initially, this was an inverse fair value gap. This was a small fair value gap here. What did the market do? The market closed above this. Okay, what happened to the market? It fell from here. It was facing rejection from here. But what did the market do next? It closed here. So what has this become for us now? This has become an inverse fair value gap for us. Inversion has happened. That means we got a closing here above the fair value gap. Selling was initially imbalanced. There was a fair value gap. It closed above that. And what happened next? Look, as soon as the next candle formed, this one touched above it, and you can look at the market momentum. After that, okay, look at this, look at the momentum. After that, there's a one-sided rally upwards. Okay, so, this is how an inverse fair value gap works. Where will you find it? You'll mostly find it at the bottom or the top. Mostly, if it were in the middle, it wouldn't work. 70 to 80%. I'm telling you based on how much I've traded. I could be wrong, or it could be based on market conditions. So, you should understand that. We've now fully understood this. The last topic left is what is a volume gap? And how do we consider it? Okay, so, a volume gap is nothing more than a gap, brother. Look, this is what happens. Okay, where there's been no trading. What you're seeing here is that there are more weekly losses here too. This week, or this week. Okay? So, this is called a volume gap, or what is it called? It's called volume voids. Why? Because, look, there are no buyers or sellers here, brother. There are no buyers or sellers here. They did enter, but no one won here. Okay, so, this is where volume voids happen. What does that mean? This also acts as a liquidity indicator for us and acts as a fair value gap. Okay? So, as soon as the market reacts here, there are two types of reactions. Either it respects it or it disrespects it and reverses from there. Okay, what happened here now? The market disrespected this volume gap, closing above it, and the second candle closed below it again. So, what we need to look at here is the market's price action. What is the market bias? What is the end market sentiment? We have to keep all these things in mind. As for how to trade volume voids, we'll learn this in a next dedicated video. The current topic is the fair value gap, but you should have basic knowledge of it. That's why I'm teaching you everything in depth. Look, this lecture is getting very long. I agree, but trust me, I have no interest in making such long lectures. If I wanted, I could just teach you about the fair value gap. This is a gap. It taps on it. The market reverses. I could teach you this and then get you out. But brother, you should know all these things. Okay? So, this is my point. See how dedicatedly I want to teach you. The rest is up to you, whether to study or not. Now, brother, let's come to your favorite topic. Brother, you've given me so much knowledge about this, that happens, that happens, okay? You've understood this, brother, how to trade it. Tell me this, okay? How to trade it, okay? Don't tell me the rest. People say the same thing. Forget the rest. Tell me how to trade, okay? So, how to trade, I'll teach you that too. Look, whenever a fair value gap is forming in the market, okay? First, you have to watch it for 1 second, 1 second. I have to explain a little bit here. The last topic is 1. Having explained that, we'll move on to the entry model. So, we've now understood what a fair value gap, FVG, is. What is a FVG, start FVG, a field inversion, or an inverse fair value gap, a volume gap, and a liquidity void? Again, what is momentum? We've understood all these things. Now, let's see which FVG works. Let's consider this one, okay? It happens like this. Multiple FVGs are created in the same portion, in the same leg, whether on the selling side or the buying side. You might be wondering, which of these FVGs will work? You ask me, which FVG do you think will work? You'll say, sir, this one will work. Why? Because it's the thickest FVG, okay? That means it has the largest gap. So, this one will work. This one won't work. No, it doesn't work like that, okay? Whether the FG is as thin as a line or as large as a FG, both have the same power. You just have to see which FG will work. What do you need to do to see that? Go to your fib retracement tool. Go to the fib retracement tool and apply a fib extension from the point where the movement originated to the full swing leg. And then see that all the FGs below this 0.5 are useful. No matter how many FGs are above that, you shouldn't pay any attention to them at all. What will the market do? It will rise above them. The market will definitely react. It will break back. It will react above this as well and break. The market won't reverse until these FGs below 0.5 are touched. Why? Because this is your discount zone. Right? If you know the doubt theory, you'll know that the market discounts everything. Right? So, what should you keep in mind? Simply put, all the figs below 0.5 of a swing on the 0 fib retracement are useful. And you have to trade them. There are rules for this too. Even if there are 2 or 3 figs below 0.5, which one will work? You'll need to see if there are order blocks, breaker blocks, PD arrays below. What's there? What's not? We'll have to look at all of this in the charts in the upcoming discussion. For now, we'll just talk about figs. Okay? So, you understand which figs work for you and which ones don't. Okay? That's it for the buy side. Now, how about the sell side? Do the opposite for the sell side as well. Place a fig from top to bottom. Above 0.5 is called the premium zone. All the figs in this premium zone are useful to you. The remaining fugs in this discount zone are useless to you. Leave them. They'll just trap you. All these traps are smart money traps. They trap new SMC coins by looking at their fug. They react and break them. From here, they react and break them. And exactly where it goes above 0.5, you'll actually see the reaction from there. Okay? I'll take you through this example on a chart. So, let's look at our USD JPY chart again and see the entry module there to see where and how to enter the fug. See, we've understood this. We've understood the entire basics of FG. Now, how do we trade it? See, if a fug is created, we need to wait for the market to come back and touch its fug. If the market comes back and touches the CE level in its FVG, right? This consequent increase, this midline, then first you can create an entry module. Okay, you can create an entry module here that will hit your CE level, and tapping it will allow you to enter directly. This is your first entry module. What will your stop loss be? Okay, your stop loss will be a buffer slightly below the FG. Okay, what will your target be? Nearest high. First, the nearest high. After that, think about your trailing level. Okay, but first, the nearest high, right? So, you've created your entry here, and this TP here is your hit. Your TP is hit in one candle, right? Your TP is out in one candle. So, I'll move it to the side, okay? What's your second entry? You need to plan your entry, placing a stop loss slightly below the end zone. What target can you set? Nearest high, first target. The first target is always the nearest high. No matter what anyone says, the first target is always the nearest high. You'll have to consider your risk-reward balance, okay? This is your second entry module, okay? You understand that, okay? So now we'll understand how to trade a fair value gap on a higher time frame. Okay, so let's move on. I'll show you a 1-hour chart of USD JPY. On this, I'll explain how to trade a fair value gap on a higher time frame. Okay, so this is a 1-hour chart of USD JPY. Here you can see that a very large fair value gap has formed. So, does such a fair value gap fit into our risk management? If it does, that's fine. If it doesn't, then how should we trade it? We've understood all its components. We've understood its rules, where to enter and where not to. Now we'll understand how to trade here on a smaller time frame. Okay, so let's go to a smaller time frame and see where to place the trade. Look, this is that fair value gap. What do you have to do? When you hit a fair value gap on a larger time frame, you don't have to make an entry immediately. You have to go to a smaller time frame, and on a smaller time frame, you have to look for any market structure, chief, change of character, break of structure. As soon as you see a change of character, break of structure, like you just saw it here, okay? Here, I saw a change of breakout structure in this zone. As soon as it goes above this, you have to catch any fair value gaps below this one or in this leg here. Okay, just like there was a fair value gap here, there was a fair value gap here. Okay, place your entry above it and place your stop loss below the swing high, okay? For example, you made your entry here, but you need to place a stop loss below the swing low and take a significant reward here. Okay? So, this is how you trade. If there's a fair value gap on a larger time frame, how do you refine it to a smaller time frame and trade with a smaller stop loss? I hope you understand. What is the third entry module? The third entry module is where the market comes and taps on the FVG and shows you some price action or a market structure shift. Okay, for example, here, in an internal structure, we found a boss. Below this boss was the FG. For example, tapping on the FUG, there was an order block below. You can make an entry from here. Okay, that's an advance, which we'll cover in an upcoming video. So, as of now, there are only two entry modules. Either enter from the start of the FUG. In this, your risk reward becomes larger because the stop loss becomes larger, and your RR decreases. If you look at this, you'll see that the target is the same, everything is the same, but in this trade, your risk reward is 1.2, and in the previous trade, your risk reward is 1.4. Why? Because you entered at the 0.5 level of the FPG. Okay? Now you understand where to enter. The most important thing you need to understand now is where not to enter. Okay? If the market comes and closes a candle below the 0.5 level, never enter a trade above it in your favor unless you're a beginner or have enough experience trading the market. If you make a trade below 0.5 on the bullish side, if you get a candle closing below 0.5 on the bullish side, then your fair value gap is useless. Then, no matter what the target gives you, you shouldn't enter it. First, and then, which one closes below it? Below the entire fair value gap, you shouldn't enter immediately. Then, this link, this fair value gap, has failed. Then, it's trapped, and it becomes an inverse fair value gap, which we explained a little while ago, inversion, right? I hope you understand why I'm sharing all the information first and
Guys, as you know, this is all this is how the fair value works, and I already watched his video multiple times. I got this notebook here. Let me show you guys. Yeah, I got a bunch of things like bunch of plant. Fair value gaps, from my perspective, fair value gaps doesn't work that much. Fair value gaps, sometimes it works. There are different things like premium zone, discount zone, which we're gonna learn in the future. But that makes sense in premium zone and in discount zone. We're gonna learn in future. Guys, that is for today. Today we learned how to trade fair value gaps, advanced FVG concept, and now we will go and see in the chart, like how we can improve in the chart and how to spot fair value gap. Let's go. So we are here in the fair value gap. We're at 15-minute chart in the gold in Chow USD. Let's do the method that he said, Fibonacci retracement. Where is Fibonacci retracement? Fibonacci retracement. In the selling, in the buying from bottom to top, and below 0.5 down, fair value gaps works. So below here we got multiple. We got here. This is mitigated fair value gap, so it doesn't work. And another one is this one is okay guys, as you can see that market came like it did this whole sweep. It came fast, it created liquidity like this fair value gap, and just as we did, if since this move didn't happen, like if market comes down maybe it can reverse, but since we only saw this point, we can see that in this FPG market came and it rallied here. It rallied like good amount. So somehow FPG works, at the same time it doesn't work. It's depend on where the FPG is, you know, like for example below 0.5 is premium zone. For like in the when you are buying, it's in the discount zone, and up is premium zone. When you are selling, you have to, if you want to put a sell order, you have to see if the market is, the candles are in the premium zone, this above, and when you are buying, it has to be in the discount zone, so you can sell in the premium zone. So guys, that is for today. Chart observation, SMC, and trading in the zone by Mark Douglas. Today, day 6, we read trading in education, SMC study, we did chart practice, we find it, and mindset session throughout the video. Yes, thank you guys for today. Day 6 complete, and let's see you guys in day 7.